So, you know how it felt like everyone was out spending money like crazy during the holidays? We all saw the crowded malls and piles of delivery boxes on doorsteps. But it turns out the actual numbers tell a completely different story. And honestly, it is a bit of a wake-up call for where the economy is heading. We just got the retail sales report for December from the Commerce Department, and guess what? It was unexpectedly flat. I mean, literally unchanged. Zero growth from the previous month. This is a massive shift because back in November, we saw a pretty solid 0.6% increase. So everyone assumed the party would keep going through December. But it seems like American consumers just hit a wall. It really raises this big, uncomfortable question we have all been thinking about, but maybe scared to ask, which is, are we looking at a broader economic slowdown here? It's like we've been running on fumes, keeping our wallets open even when we felt bad about the economy. But now the reality of a faltering labor market and those annoying, persistent high prices has finally caught up to us. Think about it. Wage growth is cooling down, inflation is still nagging at us, and eventually something had to give. The data shows that furniture store sales dropped by 0.9%, and clothing retailers saw sales go down by 0.7%. That makes total sense, right? When you're worried about money, you don't go out and buy a new sofa or a whole new wardrobe. You stick to the basics. Even though sales were up 2.4% compared to last year, that's a pretty big drop from the 3.3% annual increase we saw in November. It's a clear signal that we are pulling back. And considering consumer spending is basically the engine of the U.S. economy, accounting for over 2/3 of all economic activity, this flatlining is something we need to take seriously. Now, before we go into full-blown panic mode, we need to peel back the layers here because there's a fascinating divide happening right now. It's almost like a tale of two economies. On one side, you've got the high earners who are doing just fine. The stock market is hitting new records, their portfolios look great, and they're still spending. But then you have the rest of the country, the folks who are actually feeling the pinch of everyday life. The Labor Department just reported that wage growth slowed down to just 0.7% in the fourth quarter. That's the slowest pace we've seen in more than 4 years. So while expenses are up, paychecks are barely budging. Gregory Dacko, who's the chief economist at EY Parthenon, put it really well. He said Americans are shifting toward the economics of necessity. Basically, we're spending money on things we have to buy, like gasoline and building materials, which actually saw an uptick in December. But for discretionary stuff, the fun things like electronics and clothes, we're closing our wallets. It creates this weird situation where the headline numbers might look okay to some, but the underlying reality for the average family is getting tougher. Chris Zaccarelli from Northlight Asset Management nailed it when he said consumer spending has finally caught up with consumer sentiment, and not in a good way. We're no longer relentlessly increasing our spending. We're being cautious, we're hesitant, and frankly, with the government shutdown delaying this data, we're only now getting this full picture. It all comes down to whether this is just a temporary little blip or the start of a longer trend where we just stop buying things. We've got a report on the labor market coming out on Wednesday and fourth quarter growth estimates next week. And honestly, those reports are going to be crucial to see if this weak spot is going to turn into a bigger bruise on the economy. There's a silver lining here if you look closely, so don't lose hope just yet. Even though the job market feels a bit shaky, it hasn't collapsed. The fears that gripped everyone last year about a major labor market slowdown have eased up a bit. Sure, job creation in December was modest, but the unemployment rate actually dipped to 4.4%. That's not terrible. Michael Pierce, the chief U.S. economist at Oxford Economics, thinks this whole spending freeze might just be temporary. He's betting on a bounce back in the spring. Why? Well, think about tax season. A lot of people rely on those tax returns to make big purchases, and that cash injection is coming soon. Plus, remember those 3 interest rate cuts the Federal Reserve made last year? It takes time for those to filter through the economy, and we might start feeling the relief from that soon. Pierce believes that the combination of tax refunds and a stabilizing labor market will drive a rebound. It's kind of like we're holding our breath right now, waiting to see if the air clears. If people keep their jobs and get a little extra cash in their pockets from taxes, we might see the confidence come back. But it's a fragile balance. We're walking a tightrope between a soft landing and a hard stall. The fact that the data was delayed because of last year's government shutdown makes it feel like we're looking in the rearview mirror, trying to drive forward. So while the holiday spending was flat, it doesn't guarantee a recession. It just means we're being smarter, more careful, and maybe a little little bit more protective of our bank accounts until we see what happens next. It's going to be a very interesting few weeks as we get more data, but for now, it looks like the era of spending without thinking is officially over.